Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. I hope you had a restful weekend and I wish you all a productive week ahead. I am having to film today's episode in a separate office. There is a bit of an echo. My apologies in advance. I hope this is not too distracting. It's Monday, so as usual, we have an economic-heavy episode today. Over the weekend, the National Bureau of Statistics published China's official consumer price index for the month of April, along with other numbers. The index rose 0.3% from a year earlier, holding above zero for a third month, while industrial prices extended a long decline that highlights weak demand in the economy. Factory gate prices have remained stuck in deflation, as they've been since late 2022, and these numbers suggest that deflationary pressure remains a threat to China's economy. Economists say China's persistently weak inflation readings suggest Beijing is unlikely to be able to count on the country's consumers to hit its ambitious growth target this year. The US-based Wall Street Journal explains what many regular China Update viewers have no doubt already anticipated. Quote, instead, Beijing has been doubling down on its manufacturing industry, particularly to offset the drag from the morbid property sector, which, at its peak, accounted for roughly 1/4 of the country's economic output. This factory-centric strategy, however, risks further exacerbating downward price pressures and fueling trade frictions, economists caution, pointing to alarm in Western capitals about low-price Chinese exports. End quote. There are concerns when we look into the numbers too. US-based Bloomberg writes that some of the rise in consumer prices may be due to administrative decisions rather than any improvement in demand. Local governments have been raising utility prices and train fares in recent months, a move that could push the price index higher but leave households with less spending power for other purchases. Meanwhile, industry data released Friday showed that China's car sales fell 5.7% in April from a year earlier, despite fierce price competition, suggesting consumers remain cautious. Next up for the economy, today in an exclusive, UK-based The Financial Times reports that Beijing has kicked off plans to sell 1 trillion yuan, $140 billion of long-dated bonds. Quote, as Beijing ramps up spending to stimulate the economy, end quote. The outlet reports, citing 2 unnamed sources, that the People's Bank of China has asked brokers for advice on pricing the sale of the first batch of the sovereign bonds. We remember the government announced plans for the bond sale during the so-called 2 sessions back in March, saying it would support investment in key areas and reinforce economic momentum in the second quarter. The deputy head of the National Development and Reform Commission explained last month, quote, the bond sale is a critical part of the concerted efforts to support significant, urgent and challenging projects that are essential for the modernization of the economy. These are all projects that have long been intended but not materialized and requiring a central level drive. End quote. The Financial Times explains that the sale comes after China's regional banks piled into long-dated sovereign bonds in the first quarter of this year, driving the cost of government borrowing to record lows, as they seek a haven from volatility in China's equity and property markets. China sold similar long-dated bonds in 2020 when 1 trillion RMB was raised to try to control the COVID-19 pandemic and boost infrastructure investments. The bonds being sold this time are expected to have longer maturities, as a way of funding long-term projects while alleviating the debt burden on local governments, an issue regular viewers know too well. The new bonds differ from normal government bonds in that the money raised is for targeted purposes. This is the 4th round of special sovereign bond issuances, after the sale in 1998 to recapitalize state banks, 2007 to set up its sovereign wealth fund, then 2020, then 2024. We can see that these sales are getting closer and closer together. The Financial Times adds that the first batch of the new bonds to be issued will be for an amount between 80 billion and 100 billion RMB. Most will have 30-year maturities, but there will also be some 50-year bonds. Quote, this comes at a critical time for China to reshape its debt structure. Compared to a global standard, China still has significant room, potentially trillions of yuan worth of bond issuance over the next 5 to 10 years, to let the central government take up more leverage and boost investments. Next up, Chinese financial media outlet Yicai reports over the weekend that the central metropolis of Wuhan has opened the nation's first public service spot for drone and vertical takeoff and landing aircraft companies to accelerate the development of the so-called low-altitude economy. The outlet explains that China's first dedicated window for the low-altitude economy at a public service center was set up in Wuhan's East Lake High-Tech Development Zone. Low altitude refers to aircraft flying below 3,000 meters off the ground. According to the China Center for Information Industry Development, the scale of China's low-altitude economy is expected to top 1 trillion yuan, $140 billion by 2026. 4/5 of Wuhan-based enterprises engaged in the research and development, production and sales of drones, as well as flying such unmanned vehicles, are located in the area, and some of them have industry-leading R&D advantages in surveying, mapping, thermal imaging and data transmission. Quote, Wuhan is quickly developing its low-altitude service industry, but the upstream parts of the industry chain, such as the supply of key components and drone manufacturing, are lagging, partly because local university graduates tend to be better at application instead of making hardware in comparison to those of other major cities. Moreover, most drone startups are privately owned, so they face the common obstacle of insufficient capital, talent, and market demand, which makes it more difficult for manufacturers to succeed. End quote. Next up, the big story for today are major developments in the housing crisis. If you're getting some value from today's episode, as always, it's a huge help if you can hit the like button. Subscribing, if you're not subscribed, is also a big help. And Patreon and Buy Me a Coffee links are in the description for those who want to help keep the channel financially sustainable. Next up, we turn to the ongoing property crisis. Hangzhou, provincial capital of wealthy Zhejiang province, and Xi'an, provincial capital of the less affluent Shanxi province, are the latest cities to remove housing purchase restrictions. Yan Yuejin, director of the Shanghai-based E-House China Research and Development Institute, called Hangzhou's move especially very significant, adding, quote, the relaxation will have an important implication for other cities where curbs are still in place and will play a crucial role in shoring up confidence. End quote. Prices of new homes in China's 70 medium and large cities fell for a 10th consecutive month in March, dropping 0.3% from February. Over the last few weeks, we've seen several major cities across the country remove restrictions put in place to reduce systemic financial risks in the hope to see some revival in sales. Despite these and other moves, however, China's protracted housing slump shows little sign of bottoming out. New home sales from China's top 100 developers plunged 45% from a year ago to $43 billion in April, according to private data from China Real Estate Information Corp. Sales were down 13% from the previous month and about 20% lower than the level at the end of 2020, when the downturn began. We remember too that party leaders at a recent agenda-setting meeting of the Politburo hinted at new measures to digest existing housing inventory. Quote, the central government has changed real estate policy to allow local governments to set policies that match local conditions, and while the policymakers do not want to encourage a new round of property speculation, they do want to spur more transactions to and to generate cash flow for struggling developers. And they want this to happen without prices dropping too much, which could have all sorts of financial and social stability ramifications. If the removal of housing purchase restrictions does not spark a recovery in sales, then expect prices to drop a lot more. End quote. According to Chinese financial media outlet Cailian News, the remaining places still implementing housing purchase restrictions are Hainan province in the south, the 4 first-tier cities of Beijing, Shanghai, Guangzhou and Shenzhen, as well as certain areas of Tianjin. And speaking of this northern port city of 15 million people, today US outlet CNBC published a piece saying that a group of around 1,500 homebuyers in the city of Tianjin have yet to see, let alone move into, the apartments they say they paid for 8 years ago. This story provides a useful reminder of the costs of the housing crisis at the individual human level, behind all the macro numbers. It also reinforces the warning that the housing crisis risks blowing up into a political crisis as public anger grows. As is common in China, the apartment complex in Tianjin sold the units before they were completed. The promise was that they would be ready by 2019, but the majority are still unfinished, according to 5 of the home buyers who spoke to the outlet. Following early attempts to recoup their money or to garner information about their property purchases, the outlet reports, a few buyers even said police visited their homes, sometimes in the middle of the night. One buyer explained, quote, "I feel like I've been tricked this whole time. My only request is that I can return the house and get my money back. Even if I am able to get the house, I will feel bad." End quote. The outlet explains that some buyers said they had bought the apartments as a place for their parents to retire or for their children to attend school nearby. In the 8 years of waiting to move in, one buyer said that their parents had died while waiting for the new home, and another said their child had grown up and found another school instead. Quote, "I think it's just another reflection of how deep the troubles are for the real estate developers. What's happened in Tianjin is not a unique phenomenon. I think there should be more of these cases coming out in the near term." Real estate developers in China racked up high levels of debt as they expanded rapidly during the property market boom years. Pre-selling homes became a common way to finance, with developers recklessly using pre-sold home revenues to complete existing projects, relying on future pre-sales to complete the new obligations. This system came crashing down with the housing crisis, of course. The CNBC story explains that these home buyers were asked to approve a dispute settlement that said the apartments could be completed in 2025 or 2026. Quote, "If the buyers agreed in the next few weeks to pay any outstanding balance on their property purchase, along with other costs as determined by the developer." End quote. The proposal did not offer an alternative and said that properties must be valued at pre-market slump prices, or about double or more than their current level. In addition to paying in full for that apartment, one buyer is still paying a monthly mortgage for a second apartment in the same complex, which was meant for a relative. This, of course, is a horrible situation for the 1,500 home buyers of this particular development in Tianjin. Tragically, their story is but a tiny piece of the whole picture. Nomura analysts, in a report last year, estimated that there are around 20 million unconstructed and delayed pre-sold homes across the country. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, and I will see you all tomorrow.